Welcome back to the market update. I hope everyone had a great Thanksgiving holiday. We're recording this on Cyber Monday. This is the day when a lot of bargain hunters are going online, looking for the best deals, and planning on getting a lot of their holiday shopping done. There's actually some, such as Adobe Analytics, that expects total spending today online to surpass $14 billion. This would be on the heels of a pretty strong Black Friday, which officially marks the beginning of the holiday shopping season. We saw data last week from MasterCard Spending Pulse that showed that Black Friday spending rose just over 4% from the prior year. So that was better than expected. For November and December, if we just want to look at the entire holiday spending period, the National Retail Federation expects a total of $1 trillion to be spent in the final 2 months of the year. This would be an increase of about 4% from the prior year, so pretty strong. Although I will say this number is not adjusted for inflation. So if we assume that inflation generally is around 3%, then on an inflation-adjusted basis, this means that spending will have risen about 1% year over year. So not great, but it's an increase nonetheless. And I think that's really important because right now we are all on the lookout for signs of a weakening consumer. We know that this economy, the engine of this economy is consumption. So we really want to pay attention to consumer health. We know that there's a lot of fears about this K-shaped economy where some, such as those in the higher net worth or income tiers, are doing okay in this environment, and while others in the lower income space aren't dealing as well with things like inflation. They don't have the luxury of a stock portfolio or a home with a low mortgage rate where they are seeing their net worth rise the same way. So the health of the consumer is really one of those things that is top of mind right now. Now, that's on the spending side. That's some of the economic data that we have been watching. Let's talk about markets for a little bit. I will just highlight the fact that the bargain hunting really started for consumers well before Black Friday. We saw in recent weeks that the S&P 500 had a drawdown of about 5% from its all-time high. Before the Thanksgiving holiday, we saw a lot of investors came rushing back, so that drawdown was relatively short-lived. The markets finished Friday of last week, so just after Thanksgiving, back around an all-time high. So what really led to this strong rebound? I really think that if we are honest with ourselves, it's not necessarily the data so much as the fact that we actually saw expectations for a Fed rate cut rise, and that provided some fuel to the market, boosted confidence among investors. They saw this as an opportunity to go in, buy some stocks that were trading at a relative discount to where they were a couple weeks before. And I think the data bears this out, that the S&P 500 during the month of November really traded in line with expectations for a Fed rate cut. And that Fed meeting is next week. We'll hear their decision on Wednesday. But at least right now, we're looking at data that suggests that there is effectively a 100% chance the Fed will cut rates at that meeting on next Wednesday. So, where do we go from here for the markets between now and then and into the close of the year? I will just say that we're still in this period coming out of the recent government shutdown where we're still a little light on the facts in terms of data. A lot of the data has still been delayed, where we're not going to get some of it until after this next Fed meeting. And so to an extent, we're still flying blind. That means that there isn't a whole lot to throw off the Fed's plan of cutting next week, to throw perhaps some negative thoughts into the minds of investors and cause a dramatic sell-off from here. I'll also say that the odds of a Santa Claus rally or a strong one are relatively low, just because I think that a lot of the good news is priced in here, that especially being the next rate cut next week. But I will highlight that December is historically the best month of all of them for investors. We've seen on average historically the S&P 500 rises about 1.5% in the month of December. So that is a good sign. Past performance is no guarantee, certainly, but I think it does bode well for investors here over the next few weeks. I'm going to leave it there right now, but as always, if you have any questions, please don't hesitate to reach out to your financial advisor. I'll look forward to picking things back up next week when we can take a look at the information heading into this next Fed meeting.